Canadian dollar is trading well off its 2012 highs against the U.S. dollar. Currency traders don't expect the loonie to reach parity anytime again soon. That could spell opportunities for investors. David Kaufman is president and CEO of Westcourt Capital. We talked recently, and I started by asking him where he does see the dollar going.
We try very hard not to predict. You know, the fluctuations in currency are very random. Of all securities, if you even want to call it a security, it's the least easy to predict. And the reason is there's so many moving parts. So in Canada, the Canadian dollar can get strong or weak vis-a-vis a lot of other currencies depending on the world's demand, say, for resources, which is kind of obvious since we're a resource economy. But the Canadian dollar can also get weak, for example, versus the U.S. dollar, just because the U.S. dollar strengthens because there's trouble in the emerging markets, for example. So I could go on and on, which is precisely what makes this so difficult. So to answer your question, although we don't know where it's heading in the next month or two, the long-term average is around 85 cents, is what it'll take. And we're still above that right now. The fact that we were at $1.10 not too long ago is not something we can cry on our Cheerios about. We have what we have now. And the one thing I would say, it's much less likely to go back to $1.10 than to keep going down into the 85, 80 cent range. Going back to the 62, 63 cent range we saw in 2002, 2003, who knows? So
there are a couple ways this affects normal folks. Mm-hmm. One is if you want to travel to the U.S., your purchasing power just dropped. Now, maybe 15% isn't that big a deal. If it went down to 60, I guess we might feel it if we were traveling. But when we invest, and as you point out, not enough Canadians invest in the U.S. market the way they could, but many do. How does the currency play into those investment decisions, or how should it play in?
Well, first of all, if you don't want to make a play just on currency, because if you just decide to invest in U.S. dollars and you don't need U.S. dollars, you've just made your own bet on the U.S. currency, which, as I just pointed out, even the professionals are unable to do with any level of sophistication. If, however, you need U.S. dollars to live, to go on vacation every year, maybe you're a snowbird and you spend 6 months a year down there, what you would want, especially with the portion of your portfolio that's creating yield that you live on, you'd like that to be in U.S. dollars already. That way, you become, a little bit immune to these changes in the value of the U.S. to CAD because it's already in U.S. dollars. And you're not going to ever bring that back to Canadian dollars until you change your lifestyle. So that's the most obvious way to hedge against that. And as you say, if you just go from time to time and it gets more expensive, the flip side is that, Canadian manufacturers are loving the fact that they're selling into the U.S. at a stronger U.S. dollar. And maybe those people have more money to spend anyway.
Right. Now, one thing I guess that investors don't often think about, and maybe we shouldn't, is the way hedges are worked into our investments. So if I buy an emerging market ETF, do I need to take a look at how they're hedging currencies and worry about what my Canadian dollar is going to do, or should I ignore all of that?
Well, the short answer is that it's not free. The longer answer is that you're not going to be able to figure it out, and it hopefully is at a reasonable price. Yes. And it's hard for us to figure out sometimes the way they keep changing. The good news is this. Outside of Canada, virtually all securities are priced in U.S. dollars. So if there's one bet that you want to try to make, if there's one thing you want to figure out is the U.S. dollar going to strengthen itself versus the world or not?
Right.
And if you think that there are going to be tough economic times in China, in the Eurozone, in the emerging markets, or in the U.S. itself, then believe it or not, those are all reasons to bet on the U.S. dollar and hold a disproportionate amount of your assets in U.S. dollars as a sort of long-term bet on the direction of the currency.
Would you ever advise people to look at other currencies by way of an investment? So the Turkish lira, for instance, has taken a tumble because there's some political issues there. Do you look at that economy and say it's a vibrant economy that's probably overdone, I'm going to try to find a way to play it?
I think that's quite specific. The one area where you see a lot of portfolio managers in Canada, because we're very comfortable with the resource economy, is that they'll take Canadian dollars, convert into Aussie dollars, which trade very similar to Canadian dollars to each other and compared to the U.S. dollar, and it's called a carry trade because when you buy bonds in Australia, even investment grade bonds, they pay much more than Canadian bonds pay. And so that if you can convert to Aussie and then invest at 4% and then bring that back and you've made an extra 2% and you just hope that long-term correlation between the two sticks, that is a currency arbitrage. I wouldn't say that that is for an amateur, but it certainly is something that a lot of people would want to consider, or at least speak to their advisor about.
And that it simply exists because they've raised interest rates in a way to make their bond yields higher for
Well,
now?
it's sort of what happens. It's the product of Canada being one of the safest countries in the world. And so when you are a AAA country, all the bonds that you and all of your companies issue, frankly, they don't have to pay as much to people buying those bonds. In other countries in the world, you still have to pay more than virtually zero to be able to borrow money, and that's exactly what you're taking advantage of. But it's not this distressed area. It's not Greece. It's not Spain. It's not Italy or Portugal, Ireland. The list goes on and on, where there's a reason that you're getting paid more. It's that you never know. They could default. And most people believe that investment grade in Australia is money good.
All right. I'll leave it there.
Pleasure.